In response to the unfolding COVID-19 global pandemic, Congress has enacted the Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act. Last week, we sent an email titled CARES Act Overview, which reviewed some of the main components of the bill. In this video, we're going to focus on some generalized planning concepts for individuals. Again, for a full explanation of each section, please refer to our CARES Act email.
The CARES Act will provide a stimulus check or direct deposit to over 90% of taxpayers. The base amount is $1,200 for individuals, $2,400 for married couples filing jointly, with an additional $500 per dependent you claim under 17. You won't qualify if you are a dependent on someone else's tax return, and your base amount may be phased out to zero, depending upon your adjusted gross income from your most recently filed tax return. Payments to those that are entitled are expected to be received in the next 2 weeks. Initially, it was reported that if you don't normally file a tax return because you aren't required to do so, you would need to file a return to receive payment. This is no longer a requirement for those receiving Social Security benefits. Payments may be received in a variety of ways. Direct deposits may be made to the same account that Social Security benefits are paid to for retirees. Taxpayers may receive a direct deposit to the same account their refund was paid to on their most recently filed tax return. For others, a check may be sent to the last known address on file. We expect there will be issues. To address tracking down lost recovery rebate payments, the IRS will provide a phone number to individuals to report these issues. Next, I'll discuss Roth IRA conversions. When stock prices fall in pre-tax retirement accounts, the account's potential income tax liability also decreases, which is good. However, when stock prices rebound, the entire amount of the gain will eventually be taxed as ordinary income, which is potentially bad. To take advantage of low stock prices today, some taxpayers consider paying tax on a portion of their pre-tax retirement accounts by converting a portion of their pre-tax IRA to a Roth IRA. Because Roth IRA withdrawals are received tax-free, the entire amount of the difference between the stock prices today and stock prices in the future when the withdrawal is made is tax-free as well. This could be very beneficial if you are in an unusually low tax bracket this year due to the economic impact of the virus, or if stock prices appreciate significantly between now and when you ultimately need the funds. Next, I'll review coronavirus-related distributions from retirement accounts like IRAs and 401ks. Generally, you are assessed a 10% penalty on early withdrawals. The CARES Act eliminates this penalty for those impacted by the coronavirus. Pre-tax withdrawals will still be counted as taxable income. However, you can spread out the income over a period of 3 years, and you can repay the withdrawal within 3 years as well. If you are expecting your taxable income to be dramatically lower, such that you don't expect your income to exceed your standard deduction, it may still be advantageous to supplement your income first from these types of accounts up to the amount of your standard deduction and preserve your non-retirement savings. Next year, if your income returns to a normal level, you can consider paying back the distribution from other savings to keep you on track for your retirement. IRA owners over a certain age, as well as those that inherit IRAs, are required to take distributions from their accounts. This generally results in taxable income, sometimes unwanted, if the distribution isn't needed. To get around this dilemma, we've generally introduced our clients to the concept of qualified charitable distributions. QCDs simply transfer funds directly from an IRA to a qualified charitable organization such as the church. In return, the account owner does not have to count the distribution as taxable income, effectively deducting or writing off the amount given to the charity. The CARES Act eliminates all RMDs for 2020. If you still plan to give to charity or a church this year, it's likely still best to make the contribution from your IRA if you're eligible to do so. Also, if you wouldn't have taxable income up to the amount of your standard deduction without the RMD, you may still want to take it. For all others, you should consider stopping RMD payments for the remainder of the year if you have enough income or other accounts to meet your needs. You may also consider delaying your qualified charitable distribution this year and doubling the amount of the QCD next year. This may allow you to use a higher proportion of your RMD for qualified charitable distribution purposes, thereby reducing your overall tax burden. On a related note, the CARES Act also allows for a $300 above-the-line deduction for charitable contributions this year. Before, you can only reduce your taxes from a charitable gift if you itemized your deductions instead of taking the standard deduction or processed a QCD. In 2020, you will be able to deduct up to $300 in charitable contributions even if you don't itemize.
Thanks for watching this video on the benefits of the CARES Act to individuals. If you have any questions about the material that was covered in this video or anything else on your mind, don't hesitate to reach out to any one of us at Allen Capital Group. Stay safe.